and welcome to The Upside. I'm Nicole Correale. Today we're jumping into part 3 of our ETF miniseries. And if you missed parts 1 and 2, go check those out for a quick crash course on ETF basics, multi-asset strategies, and the Fidelity product lineup. Today we're tackling one of the coolest and one of the most misunderstood concepts in investing, factors. Once you get how they work, you can start making more intentional, smarter choices in your portfolio. We're talking why factors rotate, how to use them without the stress, and how Fidelity's quant team gives you a serious edge. Joining me to break it all down is Fidelity ETF strategist Vince Kraljevic. Let's get into it. Thank you for joining me, Vince.
Thanks for having me.
So, what is a factor?
Yeah, I think that's a great way to start. So what is a factor and what is factor investing is a question that comes up a lot in conversations. And I can get very technical and bore everybody by saying there are anomalies that happen that if you use a systematic approach, you can generate out, and it gets very technical. But I think just like breaking it down to some basics so that everyone can understand, not using some industry jargon, right? So a factor is a set of characteristics that a stock, if you're investing in stocks, so a set of characteristics that a stock has that may potentially lead to outperformance in the future. So what does that mean? So I guess the best way of explaining it is giving an example. So let's say both me and you are judges for a talent show. Right?
Ooh, I love it.
Yeah, so it's the Fidelity factor, right? So, or the X factor. But like it's a talent show, you have 1,000 people that show up and they all want to be famous, right? But unfortunately, not everybody can be famous, but we can start picking. So let's say we can choose anywhere between 50 to 100 people that we think might become famous.
Right.
And let's say I was a singer in a past life and you were an athlete, right? So we're going to try
All right.
Let's go with that.
Let's go with that, yeah.
So I obviously would be picking the people that I think would be famous for singing. So what's their vocal range? Do they have a perfect pitch? How many octaves? What's their range? Et cetera, et cetera.
Right.
You would be looking at how fast can they run? How far can they throw a ball? So on and so forth. So we could theoretically be looking at different things within the group of people, 1,000 people that want to be famous. And, you know, some might go on to be extremely all-stars on NBA all-star teams, so on and so forth. Some might make a career out of it. Some might flunk out, right? So based off of what we know and how to pick the best of the best, we might generate that outperformance. So relating that to investing, if you have 1,000 stocks, right, just the median, 500 will underperform, 500 will outperform. So if we can use metrics or characteristics that have been studied that can generate outperformance, that's theoretically what factors are and factor investing, and we'll just change being a singer and an athlete to value-based or momentum-based investing. So different ways of looking at stocks can generate outperformance.
That is such a wonderful way to tell everybody what a factor is. So when it comes to investing then, I think there's 6. What are the 5 or 6?
Theoretically, there's a lot. So, and there's arguments or definitions so if you look back at history, so I think the first factor, any reference to a factor, was securities analysis written in 1934. It became the Bible for value-based investing. Thereafter, Femme and French, they did a 3-factor model. They went on to win a Nobel Prize. I studied for the CFA, and we looked at quality, profitability, momentum, so on and so forth. So if you think about all of the factors, I think Bloomberg has 30 of them. But if you start narrowing it down, because people say growth, but growth and momentum can be used interchangeably, and profitability and quality, and leverage and quality, and beta and low volatility. So if you start narrowing it down, so you are right, when you start narrowing it down to the option, there's about 5 or 6, right? So if we start trying to walk through them, a lot of people have heard these, not knowing that they're factors. Some people call them investment styles. So you look at value, right? So value, Warren Buffett's favorite, buying things below their intrinsic value, right? Warren Buffett always likes getting a deal. So if you have 2 things, they're identical, one's trading at $10, one's trading at $8, and they're doing the same thing, you buy the thing for $8, right? So it's buying things below their intrinsic value. The next one would be momentum. Some people, again, confuse it for growth, so on and so forth. And that's just buying things that are doing extremely well, Like the price is going up and it's just momentum. If it's just inertia, if you push a ball down a hill, it just keeps picking up speed until acted on by another force, right? So that's momentum-based investing. The next one would be quality. So just high quality companies typically outperform. If If you're a badly run company, you'll go out of business. So high quality companies, healthy balance sheets, generating high return on invested capital, typically outperform in the long run.
Right.
Low volatility, contrary to popular belief, if you're just hitting singles, not trying to hit home runs, you're just trying not to lose, you get a better jump off point. So low volatility is a factor that generally outperforms in the long run. Dividend. So a company, typically people call them blue chips. So large companies, they're generating so much cash, they're well established that they're generating so much cash, they don't know what to do with it. So they pay it back to you either on a quarterly, annual basis, right? So dividend companies typically outperform in the long run. And the last one that's generally accepted would be size. So typically smaller companies, small cap, for a number of reasons, they're a bit more riskier. There's not a lot of people analyzing them, typically generate outperformance in the long run. So those would be the 6 factors that are generally accepted in academia and in the real world.
And what are some of the misconceptions about factors or factor investing?
Yeah, so the biggest one with regards to factors is that they work all the time, right? And factors don't work all the time. They work at different times in the business cycle. So we always say factors work over the long run, but not all the time, right? So people will see Warren Buffett on the front page of Time magazine, the best investor of all time. And then 2 years later, is Warren Buffett wrong and is this style? So they do come in and out of style, but in the long run, even in that example that I gave about being famous, you can't win the Super Bowl every year. So you can't win a Grammy every year, right? So you do come in and out of favor, but in the long run, you'll be known as, the GOAT or something.
Right. Okay, well, we often hear you and others on the team, like Bobby Barnes, discuss factors that are in and out of favor, in and out of cycle. Last year with the rise of AI, it was, momentum was really killing it. Now we're hearing it's low volatility. So what makes factors go in and out of cycle?
That's a great question. And again, I can make this extremely technical, or I can really simplify it down. So like from a technical perspective, macro and microeconomic decisions affect how factors behave. Interest rates, geopolitical risks, GDP growth, like each one of those things. But when you actually distill it down, the market is just made of decisions that individuals make.
Okay.
Right? So what drives the market, what drives factors, I would say is human psychology. So I think it was Benjamin Graham, he actually wrote Securities Analysis. He said that in the short run, the markets are a voting machine. People just vote. But in the long run, it's a weighing machine, right? So in the long run, factors work. But in the short run, people are making these individual votes and decisions, so on and so forth. So we have this great slide of a business cycle, and it kind of explains where factors work and why. So in the early cycle, value typically works. So in the early cycle, you're coming out of a recession. People have just indiscriminately sold, so they're throwing out babies with the bathwater. And for a value-based investor, they're contrarian, like, okay, they're going to go in and buy these things that they're effectively dumpster diving, trying to find these undervalued companies that people have just thrown away. And typically in the early cycle, value works. And then you get to the mid-cycle, and then psychologically speaking, the stock market's going up, everything seems great, and the common analogy is don't fight the trend. If the market's going up, just go in, and you get that euphoria. Markets just keep creating all-time highs, and that's the mid-cycle. It's typically the longest part of the business cycle. And then you get into the late cycle where markets aren't making all-time highs. Inflation might be a problem, so they're increasing interest rates. And then you hear people say high-grade your portfolio. Right? So don't get out of the risky stuff, go into the higher quality. So quality starts working in the late cycle because, they typically have higher moats, they have higher margins. So if interest rates are going up, they can protect their profit or operating margins. So quality works in the late cycle. And then last but not least, you're entering into a recession and, market might be correcting. So either having a correction or a bear market, 10 or 20%. So it's coming off, and then low volatility pays off because you're protecting the downside. They're not as sensitive to what the market does because they're typically not as sexy companies. They're just hitting singles, not hitting home runs, usually have nothing to do with artificial intelligence or things along those lines. And dividend typically works well at that time as well because you hear the analogy, you're getting paid to win.
Yes, it's
right?
a nice incentive.
So each one, it works at a different time. And there's kind of like psychological factors that go into it. And again, there are the technical factors, interest rates going up, GDP going down, things along those lines. But I say it's human decisions that mainly drive when the factors work.
Okay, so for an everyday investor, a new investor, where do factor ETFs fit in within a diversified portfolio?
Yeah, so it's a great question. I would say for a beginner. So in my job, I usually approach factors three different ways. It's either a strategic core holding, it's a tactical change that you want to do, or it's a portfolio correction that you need to make. So let's go through those. So as a strategic core holding, as I said, if you buy all of them and hold them for a very long time, in the long run, the market's a weighing machine. Academically, factors do generate outperformance, or the intent is to generate outperformance over the long run. So just strategic core holding is probably the best. Then again, where do you think you are in the business cycle? If you're a bit more intermediate or advanced, then if you think we're entering into a late cycle or a mid cycle, you might want to tilt towards one of those factors in your portfolio.
Right.
Again, I usually have those conversations with corner office brokers that they give me their opinion, we start talking about it. And then last but not least is, you're dealing with that broker and they have a portfolio and they find out that they have a hidden bias. So they've been over tilted towards growth because they've been in the US tech sector. So we find a pairing value that pairs well with that. But for a beginner, I would just say, get a diversified portfolio of all the factors because each one works at a different time in the business cycle and just hold it for the long term.
Okay, and so then this is where the Fidelity all-in-one ETFs come into play.
Yeah.
So let's unpack that.
Yeah, no, great. So, and again, I guess when we first launched our ETFs, we launched each individual factor individually, and you could choose your own adventure on how you want to construct and put them all together. And the feedback that we were getting was, could you just put them all together for us?
Right.
And that, it took us 3 years, and then we finally said, okay, let's just do this. And then we created our first all-in-one. So Balanced and Growth are celebrating their 5-year anniversary, and they've done extremely well. They've become the flagship of our ETF platform. And they blossomed into the full suite. So now there's 6 of them. So based off of what your risk tolerance is, you can pick the one that best suits the goal you're trying to accomplish. So kind of like a single turnkey solution, if you will. And the best part is we've married all of the 4 factors. So it's value, momentum, quality, and low volatility. And each one works at a different time in the business cycle. So you don't have to time the factors yourself. You just know that if you buy and hold over the long run, one factor will work at a different time in the business cycle. So I call it business cycle neutral. You're not making a call. You just know that they will work in the long run, or the intent is to work in the long run. And when you think about, and I've studied a lot, I took economics classes, got a CFA, did a lot of work in the industry, and your core allocation, that decision on if I'm a 60-40, 80-20, 100% equity, that decision based off of the research that you read dictates 80 to 90% of your total long-term returns. So it's those little decisions on security selection kind of sometimes don't even add alpha to a portfolio. So that's why I think the all-in-ones is an excellent solution for just someone starting off.
Now, Fidelity has, what makes Fidelity so great, one of the reasons that makes Fidelity so great is that we have such a robust research team and we have a great quant team down in Boston. Can you explain a bit of the history of the quant team, how you work with them to make everything come together so nicely?
Yeah, so again, we have an amazing quant team based out of Boston, and you have to go back to how this all started. So I believe we hired our first quant in 1965. So we have half a century of looking at quantitative analytics, these characteristics of stocks that generate outperformance. And obviously I make the joke, you must have done a good job because now we have over 200, I think approaching 300 quants. And somebody told me if you spin off that quant team, it would be one of the largest in the world. So embedded within us is one of the largest quant teams in the world. And they start off with, a lot of the active managers can just ask them questions. So they're a resource for even the active managers, right? And we've consolidated them down into a team called QRI, so Quantitative Research and Investments. And now it's went from being embedded or helping the active managers with questions to developing our ETF suite. So that's headed off by Bobby Barnes and his team. So I'll touch upon him in a bit more in a second. And then we're actually going the next level where we're using high frequency data, like actual decisions, information that's coming in real time, and those characteristics on how we can generate alpha, or outperformance. Right. So it's really evolved from being not passive, but research oriented, being very proactive. So we're almost on the vanguard, like on the forefront of trying to utilize all the tools that we have to kind of help investors achieve their investment goals. And then going back to Bobby, so Bobby's responsible for our factor suite of ETF. So he helped us design it. And a lot of funny stories about Bobby, but the one thing I will say is that he's literally a rocket scientist. So he worked. So he worked on the Mars rover program. So you're having a conversation with him. I'm like, I have a CFA, and he's like a rocket scientist. So there's just this different hierarchy of knowledge. And he's extremely pleasant person to talk with. We have a standing meeting with him. He explains what happened last month, last quarter, providing attribution, like what happened. He provides us what he thinks will happen. So he has a deja vu model. So he goes back in time. What do we most like? So it's a very collaborative team that we have. I could literally pick up the phone right now and ask him a question if I'm confused or something happened within one of our factor ETFs that I can't understand. He's more than happy to jump on a call. So I would say that it's an open door, open communication. And it's one of the best working relationships I probably have.
Yeah, Bobby is a gem.
Yeah.
Well, that's like you said, to the whole history of the team and, the knowledge that they bring is just something that I think is, gives Fidelity that edge, right? That, others don't have. So if viewers can take away one thing from today about factor investing or the quant team, what should they keep in their back pocket?
A great question. I'm going to give you two.
Okay.
So first is there's a lot of terms and analogies and lingo used in the industry, but factors are just characteristics that a stock have that can generate outperformance in the long run. That's all we're trying to do. We're not people try making it a lot more complicated than what it needs to be, and I guess people get confused and they shy away from it. But that's all it is, right? What does this stock have which may generate outperformance in the long run, right? And we have over half a century of looking for those characteristics. The other thing is they don't work all the time, right? They work over a long period of time. So the best strategy is kind of to have a diversified portfolio of all of them. That way each one is helping you achieve your investment goals.
Wonderful. Thank you, Vince.
Always a pleasure.
And thank you for joining me on The Upside. For more investor content, be sure to subscribe to our YouTube page to never miss an episode and sign up for our newsletter. And remember, working with a financial advisor is the best investment you can make on your financial journey. For The Upside, I'm Nicole Correale.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.